Matt Dahl of ARPG. Matt, good to see you, my friend. Happy December 5th, 2025. I did almost mistitle the live recording here, 12/25/25. I got my 25s mixed up. It's not Christmas. 20 more days to go. So you about ready for Christmas? Getting?
I can't wait. I can't wait. I need new socks. I'm out of socks and underwear. I need new socks and underwear.
I'm feeling particularly festive this year for some reason. I don't know why. I feel like last year I was like all excited for Christmas and the holidays and stuff, and I just kind of got so busy that I was so busy doing Christmas stuff that I didn't get to really enjoy Christmas at all. So like this year I'm like laser focused that I'm going to enjoy the season. Even if I am busy, I'm going to enjoy the being busy or something. But I'm trying to be particularly festive despite the fact that I have absolutely no decorations whatsoever.
You're going to force yourself to be festive, and like I'm going to.
That's exactly right. That's
no
right.
No matter what.
I'm going to
It's like looking at a steaming bowl of broccoli. I'm going to enjoy this, no matter how much I hate it.
I'm going to Clark Griswold the crap out of this Christmas season. I'm going to fight through, and I'm going to have a great time, and we're going to have a great time. So anyway, good to see you. We have some change since the last couple of shows here. We actually have job data again. So we talked about that a couple of shows ago that we haven't had any jobs data, but that's going to make the next round of jobs data really, really important because it's going to represent a lot larger sample size than what it normally would. And we're getting closer to the end of the year, and the closer we get to the end of year, the closer we seem to get to your 12-month-old end of year target, which is incredibly impressive. It's hard to predict whether the stock market is going to go up or down over a certain period of time. It is very hard to say, is it going to go up a lot or a little or somewhere in between? To be able to say 12 months from now, the stock market will be exactly at this point as a target and be within 25 points of it on the S&P, it's almost impossible if I hadn't seen you do it. Like, you're so close. If we could close the year right now, you're right on the money. That's impressive stuff, man.
Well, thank you. And I'd rather be lucky than good. And again, I think it's just pure luck because all we can do is say, listen, here's the earnings. Here's the direction it's headed. Here's where we think it's going to land. Here's the general momentum based on seasonality. And we think there's going to be a gut check here and a gut check here. But we think for the most part, it's going to head in this direction and probably land somewhere in this vicinity. And we just do our best to kind of throw darts, and sometimes we hit them, sometimes we don't. Last couple of years, we've been pretty darn close, which has been kind of nice. It's a little bit, if nothing else, it's kind of a nice ego trip. Sure. I hope I tell my wife, like, look what I did. And do you love me more now? She says, no.
I was going to say, is she as impressed by it as I am?
Not at all. Okay. Not.
I was afraid of that.
No.
Yeah, they tend to not.
She care less. I mean, she's so out of my league. She knows anything that I say to try to impress her is just me being insecure.
Yeah,
and she would be right.
Yeah, that's probably fair. So I do have a question on that. We didn't prep this at all, but I'll ask it anyway. How long have you been an advisor now?
13 years.
Okay. How long have you been doing the year-end targets and publishing it for clients?
I want to say this will be the 4th year.
Okay. How many of which I know last year was pretty accurate. If 4 is kind of a small sample size, how many times do you think over the course of your 13-year career you would have been within 5% if you were trying to give an estimate? 1% is pretty impressive, or less than that. You're within 0.5%. But I mean, even 5% is hard to do.
No, it's hard. It's hard to say. I would say probably the first 7, 8, 9 years. I mean, I was probably all over the place, and then kind of when I started to get a little bit really good handle on what I think is a good enough handle on it. COVID hit and all of the data became very, very difficult to kind of ascertain and try to figure out because everything was, sort of there was so much distortion with earnings and fiscal stimulus and inflation and all those other things. But we were able to get it pretty close. I think, I want to say 20. We finished. Well, there was one year. I think it was 2021. We finished 47.73 or 47.78. Our year-end target was 47.50. We got it within half of like 0.4%. That was really, really good. Our end of target year this year is, I think 7,000, 6,800, 6,900, 7,000. Then for the most
we
part,
have the receipts for that. I think that I think the one that you said on the show was 68 to 69, and we're at 68.75. So give or take 25 points, you're either dead at the midpoint or right at the high point. You're about as close as you can get right now.
And honestly, I wouldn't be too surprised if the market finished this year at 71 from where we're at now, because we're starting to see some real changes in the AAII readings right now. The American Association of Individual Investors. People are starting to get bulled up. They're starting to get bulled up. We have the FOMC meeting next week on Wednesday, and there's an 87% probability of another rate cut. That's likely priced in, and I think what's also likely priced in is what they call a hawkish cut. There's going to be a cut, and Jay Powell's going to come out and say, we have strong data, we have strong jobs. For instance, the jobless claims number came out, 191,000 jobless claims for initial claims number. Okay, 191,000. That is the lowest number in 32 months. Here's the thing. It's the second lowest number in 56 years. Okay, so they're going to cite that number. But then you look at the ADP number from the day before, there was supposed to be 40,000 jobs created that month at the ADP level, and there was a contraction of 32,000 jobs. So it was a negative 32,000, which would then add to it. So what I think is going to happen is there's going to be a lot of mixed messages coming out of the Fed from that meeting, but it's going to lean very hawkish. So what that for me, I think that's going to be a dovish event, because everyone thinks it's going to be a hawkish tone. So anything less than hawkish is going to be viewed as somewhat dovish. I think the bar for a January rate cut is going to be very, very high, but then you really have to start looking through. Okay, our base case for next year is 2 plus or minus 1. We think it's going to be 2, probably 3 rate cuts, with who the likely Federal Reserve chairman is going to be and who's going to start populating the board of governors. Okay, it looks like it's going to be Kevin Hassett. He's sort of at the top of the food chain on that right now. So that gets me back to the actual meeting itself, the actual press conference, the hawkish cut, the hawkish language that is provided by Jay Powell on Wednesday. No one's going to care. No one is going to care. You know why? Because he's on the way out.
Yeah. And
they know even if he is hawkish and he doesn't cut until his term is out in May, there's who's ever coming in is going to want to be accommodative, right? And that person is going, whoever that person is, President Trump's going to have their ear, right? Period. So there's going to be just a change of temperature inside the Federal Reserve. The other thing is all 5 people that are kind of nominated with us, Kevin Harsh, Kevin Hassett, Bowman, Waller, or even Rick Reeder from BlackRock. Those are the 5. All of them are economists. And I think the markets and the investing world, specifically the fixed income market, I think is really going to welcome an economist back to the head of the Federal Reserve, rather than Jay Powell. He's an attorney. He's a lawyer with a finance background. He worked for the Carlyle Group for years. So he has a great understanding of interest rates and how those work. Of course he does. But he's not a PhD economist. He doesn't have that kind of just bone marrow granularity understanding. I certainly don't have it. Those people go through statistics classes and are able to kind of parse stuff out much better than the rest of us who have not gotten their PhD in economics. You know what I'm saying? So I think there's going to be a lot. What I think is going to lead to is a fundamental change of how the Fed looks at the data, right? The Fed right now is very data dependent. Okay. What is data though? It's backward looking. Okay. And we've talked about this before, as far as the Fed requiring 3 months in the same direction in order to receive some kind of a signal for them to make some sort of a policy change. So what they're doing is they're looking dead in the rearview mirror to make a change for the future. And I understand why they're doing it. They want to see where the direction is going before they make a change. Whereas I think the fundamental shift that's going to take place is They're going to start really looking ahead. They're going to start trying to skate to where the puck is heading to. Okay. And I mean, you can make a case that that the policy rate needs to be at 3%. Get it to neutral, because we have although the jobs number, the initial claims number was pretty low. There's not a lot of people getting, I mean, we're talking about 40,000 new jobs a month right now. That's pretty low. So, these things can turn on a dime. And and there's also been a sort of, a real problem with the housing market for the last 3 or 4 years. Okay. I think that could be helped tremendously with, lowering the rates on the short end of the curve. And here's the thing, PCE came out today. Okay. Core PCE came out at 0.2 month over month. We're at 2.8% year over year. Okay. So where's all this tariff inflation? It's not there. It still hasn't shown up. It's been several months now. It's still not there. The Fed is, and those and the like are proselytizing this war on inflation caused by tariffs that's never existed. They're all standing up there.
You're making up words on me again.
Taking it the air. It's not there.
Hang on, you're making up words on me again. What was that one? Proselytization?
They're proselytizing. They're proselytizing like preachers. We have to fight this tariff-driven inflation. There's a tariff-driven inflation. There's tariff-driven inflation. Well, again, now we're not seeing any tariff-driven inflation now. This and here's the thing. This number is for September. Okay, so that's dead in the middle of when tariffs should have hit. So we're not seeing it. So this is it's a stale number. B, but it should have been when the tariffs were fully laid in. Okay, there's actually been some backpedaling on tariffs since then. So, I got to tell you that they're trying to fight this whole tariff, this whole inflation war, but there's no war. Okay, but what we are seeing is these problems starting to perk up in the job market, right? With the ADP number, although the initial claims number was pretty low. What you're seeing is people aren't quitting their jobs. Now, when you have an initial claims number that's that low, that's telling you no one's leaving. Now, people aren't firing people. That's a good thing. So there's not a lot of layoffs, and that's great. But what sort of, if you look through that number, no one's leaving their job. No one's quitting. People are like, I'm going to hold on to whatever I have. I mean, if I'm stocking cans of dog food in the back of a convenience store right now, I'm hanging on to this job. So that it's a good number, but it also could be telling you a darker story. So I'm looking forward to a Fed who looks forward, who can see what we have now, look at the data that they're receiving, and then try to make calls for what they think is going to happen, and try to keep us in a neutral range, rather than these, with the current Fed, it's so backward looking. They're always trying to play catch up. So it's like, oh gosh, we have all this inflation. We better crash. We better, basically crash the economy by spiking rates by 5.5%. Oh, there's no inflation. We don't. It's transitory. Oh, we were wrong about that too. And then they have to raise rates. So there's. I think what we're going to have is, and Scott Bessent said it best. He goes, the Fed needs to move into the background and get out of this in front of everybody all the time, talking about rates, talking about these things, and causing all this volatility with interest rates and the markets. I think they need to fall into the background and then just start looking ahead and try to keep our economy in that neutral range. Might be 2.5 on the low end, might be 3.75, 4% on the high end, whatever that number is. Okay, but trying to take data from the past and then do a half-court shot just to get it back to normal is no way to run an economy.
Yeah, windshield versus rearview mirror tends to be a little bit more effective way to try to see where we're heading with things. I think that's that can be if you're trying to drive your car looking in your mirror, that can be. I mean, it can work maybe sometimes for a little while, but not always. I will say, for anyone who is as confused as I was, proselytize, proselytize, means to convert or attempt to convert someone from one religion, belief, or opinion to another. I have to say that at 40 years of age, it's pretty rare that I hear a brand new word that I have never heard before in my entire life. You could have been speaking Russian when you said that, and it would not have made any less sense to me than it did. I had absolutely no idea that proselytize was even a word. So if anyone else out there feels the same way, there you go. And that's why you tune in to the Intelligent Investment Show, so that you can hear intelligent Matt Dahl give you words that you've never heard before and maybe didn't even believe existed.
Right. And clearly they were trying to convert people that tariffs are causing inflation.
You used it correctly. I mean, you to your credit, you used it perfectly in context. It was the correct word. You used it correctly. Could you spell it without me telling you? I think I just told you. So if you weren't paying attention, could you spell proselytize?
There's a Y in there.
There is a Y in there. Right. That's good, man.
No.
Well, for investors out there, if you're interested in talking to Matt and his incredibly intelligent and just remarkable vocabulary team, that's not great English either, but you know what I'm saying there. You can reach out to him at intelligentinvestment.com or give him a call, 702-655-8300. I had almost memorized that last time I tried to do it on the fly, and I said 8200. It is 8300. I still want to put a 2 in there, but it's they're a smart group over there. Even if I don't always understand everything you're saying, I try my best. But you make me smarter, Matt. That's the tale of a good relationship right there. Your wife may not appreciate you, but you make me smarter, and I appreciate you for that.
Well, I appreciate that very much. We need all the help we can get, all of us, right? But so, do we want to talk about next year?
Well, yeah. So you said something a second ago.
Do we want to hold that off until?
Let's tease it. Let's tease it just a little bit here, because you said something earlier in the show I want to come back to. 7,100 seems like it would be. We'll touch on technicals once in a while, but not a ton on this show. But 7,100 to me would be a pretty big move technically, even though fundamentally it's only, what's another 200 points. It's 3%. But we've hit 68.75 so many times, or 69.75. That's been a ceiling we've bumped our head on 2 or 3 times. From the technical side, if you were a technician, you would say that the longer it has taken you to break through a certain level and the more times you've tested it, the bigger the move is going to be when you do finally break through it. So if we did break 69.75 and ran to say 71, to me, or to some technicians at least, that would be a big deal. That would be a very bullish kind of breakout signal that kind of says the sky's the limit. Now, I know that's not your approach, not necessarily what I would say either, but what's taking us to 7,100? If that happens, I know you didn't say that. I want to be clear. You didn't say we're going to 7,100. You said you could see that. What takes us there, and what does that mean for 2026? Would that change before we get into teasing your 2026 outlook? Would us hitting 71 first have any impact on that outlook?
It could, and that's one of the things about the Intelligent Investment Show is we have to, willing to be flexible.
Right.
So,
because that's a mark of an intelligent investor, frankly.
Right. You got to adapt to change. Right. So I think what could happen end of next week or the beginning of the week after, I think we're going to get that breakout post FOMC. Okay. And I don't think it's going to happen that day or the day after. I think maybe Friday, the Monday of the following week, I think we're going to see that breakout. And what's going to take us to 7,100 by the end of this year, what I think is, and I think it's more likely than not, is just nothing but pure FOMO. It's going to be pure FOMO. And that will take us into the new year. People are going to be bulled up. Okay. We saw a 40% increase in bulls this week over last week. 40%. We went from 32 to 44.5%. Okay, so people are already starting to get bulled up. People are already starting to feel like, hey, I'm missing out. And remember, there's the 3-year cycle, right? 3 years ago, 2022, everything was rotten. So 2023, 2024, 2025, there's been 3 good years. So there's been a lot of people that have hated every single rally we've had from the last 3 years. They've been just perma bear after perma bear. Okay, and that narrative is bled into all aspects of the markets. Okay, so there's a lot of fund managers and a lot of advisors and a lot of others that now have to chase it because that 3-year return number is important, is how you're looked at. And I think there's going to be a lot of people that have been bears. They've been on the wrong side of this, and they're going to have to start chasing this thing. Okay, and they're going to have to start chasing it into next year and say, well, look what we're doing now. Okay, so I think there's going to be a lot of that happening. I think there's going to, so what I think next year could happen is there's going to be just a tremendous amount of FOMO and a tremendous amount of bullish energy in that front half of the year. And there's going to be a couple big gut checks. Okay. Now, if
I was going to say, isn't that because what I'm hearing you describe sounds to me like the I think you used this term or used a term a few shows ago that it's capitulation, but in reverse. A moment in time where you get when the most bearish perma bear finally throws in the towel, that can be a really bad time for the market moving forward.
Okay. All right. So I can't of course say her name or who or anything, but I have a client and she's been a client forever and she's wonderful. Okay. And she gets nervous. Okay. She has a decent amount of money. And it's always within a day of the end of whatever correction we're in. And I'm telling you, she is the best buy signal.
I know what you're talking. I had one too. I know exactly what you're going to say.
We get out of the market. I'm like, buy, you know? So, and
I had one of those too. He was the biggest pessimist I've ever met in my life in any way, shape, or form. In every way, shape, or form. And one day in the 10 years that I worked with him, he called me up and he said, you know what? I think it's time to get a little bit more aggressive and put some money in. And I said, whoop, pump the brakes. There is not an economic report on the planet that would cause me more caution than him turning bullish all of a sudden. That was the scariest moment I think of my career. I was like, we're going to fall off a cliff.
100%. And also, so Louis Navalier, he's I'm probably not saying that right. He's a big money manager, Navalier and Associates. They've been around a long time. In fact, I think they're actually based out of Nevada, like out of Reno. Big firm, been around, 40 years, something like that. He described next year as economic nirvana, lower rates, consumer discretionary, everything is going to come back. There's, consumer sentiment. Here's the thing. Consumer sentiment right now it was 51 last month. It went up to 53.3. 53.3 is terrible. Okay. That's lower than, we haven't been here in a long, long time. This is the lowest since June of 2022. Now, it's still lower than November of 2008 and August of 2011. Those were at 55.3 and 55.8 respectively.
Wow.
June of 2022, in the height of the inflation scare, it got down to 51. It's at 51. It was 51 last month. It's 53.3. So that consumer has a long way to go. Okay. So I think there's going to be some discretionary growth next year. Okay. Of course, we're going to have, your AI enablers, your semis, your clouds, your computing, your comm services. We like biotechs next year. We like industrials, the cyclicals, the financials. We really like home builders next year too. So we like medical devices next year because as rates come down, a lot of capital requirements for those companies. We think that's going to be helpful for them. And we like the SMIDs, the small and your mid caps too. So next year is going to be a very nuanced portfolio. And we think it's going to be a pretty good year. What I think next year is going to look like is going to be very, very calm, which is odd because it's the midterm year. And if you take a 4-year presidential cycle, right, then you cut them up into 8, you cut them up into half years and you have the 8. The first half of the midterm year is the worst of the 8. It's gnarly. I don't think we're going to see that this time. I think we're going to see a lot of FOMO. I think we're going to see a lot of hope of a new federal chairman. And I think there's going to be some gut checks along the way for whatever reason. Like I said, we always get by the bus we don't see. But for the most part, I think 2026 could look and feel, outside of what's going to happen with the election, a lot like 2017.
Wow.
I think it's
going
to be
the calmest, definitely the calmest year I can remember. I don't know if it's the calmest year on record, but it was definitely the calmest that I can remember.
Yeah. It was calm. So I think it's going to be calm. And I think if we get a couple gut checks here and there, that could bring us to, will bring us to our year-end target, which is a decent target. We're not overly bullish on it or anything like that. We don't think it's going to go to 8,000 or 8,500 or anything like that. But if we get to 7,100 by the end of this year, that could change the math because, momentum has a way of just taking over.
Yeah.
And so, and we, if we're looking at, because here's the thing, one of our, we always like to, again, skate to where the puck is headed. I love that Wayne Gretzky analogy more than anything. But what I think the general public doesn't get when it comes to investing, especially investing for the benefit of others, is 2026. That's already priced in. Those earnings are over. 2026 is over.
Yeah.
2026 is over. So it's already done. So whatever those earnings are, now they're gonna change here and there. I get it, but as far as what those earnings look like, that's already fully priced in. Yeah. So we're looking into 2027.
Yeah.
To get our numbers.
Well, next time maybe we'll dive a little deeper on the details of 2026 and maybe get into some of the particulars of that and some of those 2027 numbers and 2027 numbers and kind of what you say they are, and maybe throw your year-end target out there if you're ready for it at that point. Do you have the number already?
I have the number, and it has a buddy this year.
Oh, really? I can't wait to hear about that. That sounds interesting.
Its buddy is the yield on the 10-year.
Oh, okay. All right. Tandem predictions. I like it. Well, I will see you next week. Everyone else, stick around for the disclosures. Summation of that is basically we're just here for your entertainment and education purposes only, but we'll say it in the compliant way here. Matt, I'll see you next Thursday. So if you're a regular viewer, we will not be here Friday. Matt has a Christmas party, you said? Company Christmas party?
It's our company's Christmas party on Friday. So we are going to eat, drink, and be merry on Friday. So we will see you all on Thursday.
Sounds
because if you see me on Friday, I mean, who knows what I'll predict?
The disclosures would get a lot longer.
I'll be covered in confetti and wearing a Santa hat and holding an eggnog.
Most of the show on Friday would be disclosures and disclaimers, basically afterwards of us just trying to cover our butts. Yeah.
So, don't listen to a thing he said.
That's right.
He didn't mean it. He didn't mean a thing he said.
That's right. Well, see you next Thursday, 1 o'clock Eastern, 10 o'clock Pacific, and enjoy it, man. We'll see you then. Enjoy your weekend, and see you next week.
See you next week.
Bye. No disclosures. There we go.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risk, and there is no guarantee of any future results, performance, or success.